Hey, what's happening, y'all? What's happening? It's your boy Willie Beam back in the building. Just want to thank y'all, man, for tuning in to another episode of Mirror Check. Please visit our YouTube channel, Mirror Check Podcast. While you are there, do me a favor, like and subscribe to our YouTube channel. Also, please share our content so we are able to have a greater impact, man, across the world. Also, go follow our social media handles, our Instagram, at Mirror Check Podcast, Twitter at Mirror Check _ and also TikTok at Mirror Check _. Also, to stay connected to us, to our Mirror Check Podcast for latest events, please visit our website at www.checkyourmirror.com, where you can purchase exclusive products, listen to all our episodes of our podcast, and subscribe for latest news and releases. And we got some great things in store for y'all, great things on the way. And so with that being said, man, if you're the one that's always pointing the finger at someone else, that means that your mirror is dirty. So what I would advise you to do is take a step back, reflect, and check your own mirror. Peace. Hey, what's happening? What's happening, Mirror Check family? I hope all is well with y'all. Hope y'all are doing great on today, man. Just want to kind of follow up with y'all on our last episode, man. How we talked about credit repair and different things like that. But I'm excited for this next episode that we have in tag, man, episode 4, which is our part 2 of our breaking generational cycles, man. I'm excited for the guest that we have on with us today, man. Somebody that I know very, very well, a brother, somebody that I've been knowing for a very long time, man. So you guys are in for an amazing treat, man. So Ishmael, man, how you doing, man? How you feeling, man?
Man, I'm good, man. Everything good, man. How you doing?
Man, I'm great, man. Just excited to be able to get back on and pour out some more value. Like I said in the beginning, our platform is basically bring value to the community, man.
Yes,
to
sir.
give people value and having influential leaders, on our podcast, be able to share, their story, share how they can bring value, to the community and to those that are tuning in. And so, yeah, man, I'm excited, man. And so now, kind of want to bring this guy in. Like I said previously, this is somebody that I know very, very well. Been knowing for a very long time, since high school, man, and been knowing in ministry as well. So it's like a brother to me. His family is loving people, and so he's a brother. He's also a husband. He's also a father, man. Has multiple hats, man. And so I want to introduce none other than my brother Chris Winston, man. What's going on? What's going on, brother?
Hey, what's going on, Mirror Check family, man? It's good to be here. I'm happy y'all had me, man. I'm excited to hang out with y'all, man, and have a good conversation here.
Yes, sir. Yes, sir.
Yes, sir. Yes, sir. It's good to have you, man. So I guess to kind of share with the listeners before we get into the meat and potatoes of what you do, man, and what you do to serve people. Kind of, I guess, share with the listeners, man, your background, and I guess your upbringing.
Man, my upbringing, I really had a normal American upbringing, man. I grew up in here local, Fort Worth.
Yes, sir.
Stop 6 on the south side. Everywhere you name it, man, I probably lived there growing up, man. Just some people would say it's a tough upbringing, but I kind of, you weather the storm. You don't even realize it's tough until you get outside of it. So people start telling you that's not normal. So
Yeah.
Yes, sir.
when I was growing up, I thought it was just normal. Everybody had the same lifestyle. So, I mean, I thought it was just regular. I thought it was a good upbringing.
Right.
Yeah, man. Now, I'm doing mortgages. I've been doing mortgages for about 2 years. Before that,
Okay.
I was in the real estate and property management side for about 6 years, man.
Oh, wow.
Yeah, and so I got outside of that, came to the mortgage side, and the main reason for me doing that really was because when you're trying to help people buy a house as a realtor, and it was so many times that if someone can't get approved, you kind of feel helpless. You can't do anything about it, and that feeling just didn't sit right with me all the time. And I was trying to figure out a way around it. I was like, you know what? Let's go to the opposite side to make sure I can do something about it. So that's kind of how I got into the mortgage side, because that's a little more hands-on. I have a little more say-so, if you will, and if somebody can get a house.
Okay.
That's why I'm here.
That's good stuff, man. That's good stuff. So I guess since you already got into the the meat and the potatoes of what you do, man, I kind of want to just share this first question with you. So I guess what sets you apart from other mortgage lending officers being in this industry, man? What would you feel like sets you apart?
Man, I'm not really gonna say all the same cheesy salesman stuff about how I can get everybody the cheapest and everything like that. Really, I would say the main thing that sets me apart is that I work with everybody. It's not like your normal situation. You go if you were to go yourself into an office today and your credit wasn't where it was supposed to be, or your income wasn't where it's supposed to be, they'll tell you, hey, Mr. Willie, I'm sorry, we can't get you a loan today. And that's kind of the end of that story there. So for me, where I really kind of cut my teeth at, if you will, is that if you come to me and you're not ready, at that point, it's not over for me and you. We're going to come up with a game plan. We're going to really dive deep into finding out, okay, cool, you're not ready to get your $300,000 house today, but what can we do as far as your credit goes, and just written savings and assets, getting those in where they need to be so we can get you to where you want to be. And so that's where I cut, because so many people come to me and say, oh man, I'm thankful that you work with me, because all the other lenders just told me I was denied, and that was kind of the end of the conversation.
Bye, Felicia.
Okay, so for you, man, you found a way to, I guess, to persevere and do the most that you can for that client, or to help them get, what they need. Like you were saying, some people just, when they feel like, they've been declined or, dissatisfied, that loan officer might not go further and beyond, help that person. Right. So like you were saying, that's good, man, being able to go above and beyond and help clients get in the home that they want. And so I guess to kind of move forward, what would you say, even for me, kind of speak for myself, me and my wife, hopefully here in the next maybe 2 or 3 years, man, for us to be, homeowners and have a home for ourselves. That way we can build something of our own, have something for our family, and also be able to pass it down. And so what would you say, as far as if I was the consumer or the potential client, what would be some of my options when it comes to that, first time home buying process?
So, man, that's you have a lot of options, honestly. As first time home buyers, man, the world is your oyster, if you will, man. You have 3% programs. You have 3.5% if you go FHA programs. You're going to have some different loan level pricing adjustments that you'll have to help you out with the pricing as far as interest rates and how those are charged for you. But the main thing as first time home buyers is it's more informational than it is anything else, honestly, because a lot of times people go out there and they don't know what they're looking for. They don't know what to do. And so for you as a first time home buyer, I'm going to kind of want to hold your hand from the beginning process, really look at your credit, find out your situation, and go over some real do's and do nots of the process right now. Because the main thing, I think people get caught up in like, oh, I need 20,000 down. That's not always the case. A lot of those things are negotiable, or there's ways around it. Not that you can get into a house for free, but it's not always that, oh, you always need 20,000 regardless. And then just other things like far as like how to fix your credit, or not even fix your credit, but to make sure that, hey, just because you're approved for the house, don't go and start financing furniture right now. That's a big mistake that people make, because it can affect your credit. And so by the time you're pre-approved to the time that you close on your home, or you're closing on your home, if you went and added some more to your credit, it could affect your approval. You could knock yourself out of pre-approval or approval status.
That's a fact.
Okay.
That makes sense.
So you mentioned FHA and conventional. What are the differences between FHA and conventional loans?
So FHA is a government loan, and conventional is not. It's going to be sold to either like a Fannie Mae or Freddie Mac.
Okay.
And the main differences are going to come in like the guidelines. So with the FHA, it has 57% debt to income approval, so you can go up to 57% on your total debt towards your income. Whereas conventional, you can only go up to 50%.
Okay,
that's good.
Yes, sir. But the different, but with FHA, they have stricter guidelines as far as like the appraisal. Like the house has to be kind of in a better condition for the most part. Whereas conventional is going to be like, hey, the value is the value. Whereas FHA, they're going to go in there and they're going to look at the foundation a little bit more. And so sometimes it's not always just the value with FHA, but sometimes FHA is just going to say, yeah, we're not going to loan on that house.
Right. Okay.
And they just looked at a little harder than conventional will.
Okay. I guess to piggyback on those loans, what would you say the difference is between the loan pre-approval and the loan pre-qualification process? Most people that's listening probably want to know the difference between the two, so they can have a better understanding.
No, I got you. And that is, I can answer for myself, but it's really going to depend on your lender and how they do it. But the easy way to answer that is going to be a pre-qualification is going to be more bird's eye view. So pre-qualification is going to be like if you come to me and you tell me, hey, Chris, my credit score is 660. I make $60,000 a year. At that point, based on what I've seen before, okay, cool. You probably pre-qualified for a loan, and you get a pre-qualification. It's just a piece of paper. But it doesn't really mean anything because I don't necessarily know what the details of your credit is, if your income is true. So pre-qualification would be more or less stated credit, stated income, stated assets. This is before I verify anything. And a pre-approval is a lot stronger because I'm going to ask you to look at your pay stubs, your bank statements, things like that to verify to make sure what you told me is true and it holds up from an underwriter standpoint. So that way we're not worried about if the loan is going to blow up. Because if you just got a pre-qualification and all you did was tell me that your credit score was 660, if we get to the closing table and now I run your credit, or before that I run your credit and it comes back at a 570, now you're no longer approved because I never verified anything.
Yeah,
Right,
that makes
right,
sense.
And so you want to go for pre-approval. Pre-qualification, I tell people that's good if you're looking kind of really far out. So we don't necessarily need to know the details. If you tell me, hey, Chris, my credit score is a 640, I'll give you a pre-qualification. I say, hey, let's work on that. Let's bring that up a little bit. But we don't have to look into details because you're 2-3 years away from buying maybe. But a pre-approval, that's going to be more serious. And you can't really buy a house with a pre-qualification like a seller doesn't. Because sellers are privy to a pre-qualification isn't verified.
Makes sense.
So if you go to somebody that's selling a house with pre-qualification, they're probably going to look at you funny because like, yeah, okay, that's good, but this doesn't mean anything. But the pre-approval gets you in the door and it gets the sellers to take you a little more serious.
Okay.
That's good stuff.
So there's a thing called PMI. We're talking about becoming a first-time home buyer. Can you explain what is PMI and how long do you have to have it on your mortgage loan?
So PMI is going to be what you have typically for FHA. You're going to have it on there throughout the course of your loan.
Okay.
For a conventional loan, if you're going to put at least 20, if you put 20% down off the back, you won't have it. But if you put anything less than 20% down on your loan, then you're going to have PMI up until you reach 78% loan to value on your home. Okay. And it's property mortgage insurance is what it stands for. Okay. And it's going to be required by your lender. They require you to have that on your loan.
Okay.
That's good. That's good stuff. That's something I was definitely looking into and researching when it came to that. So I guess the piggyback, I know you mentioned earlier, the underwriting process. So my question is, I guess, who's the person of contact when it comes to the underwriting process? Is it the lender? Is it someone else? Like who's?
So me, you're me, or your desired loan officer.
Right.
In most cases, is going to be your person of contact. You can't really yourself pick up the phone and call an underwriter because they have to make their decision completely unbiased of knowing you or knowing your story or anything. They're kind of more strict to the numbers and the guidelines, what's legal, what's not legal, what's acceptable, what's not acceptable. It can't be based off your story. And so you can't really just pick up the phone and call your underwriter. But that's what, if you have a good loan officer as myself, then you can call them and they'll be able to they'll be able to get everything lined up for you, send it to the underwriter and send the most strong application for you so they can get you approved for your loan.
Okay, that's good stuff. That's good right there. So I guess let's go back, like going through that process of first time home buyer. I know even for me, I'm confused when it comes to, I guess, the certain percentage amount when it comes to a down payment on a home. So what would you say would be the minimum percentage amount when it comes to potential clients' down payment?
So if you're going to go with a conventional loan, you can go as low as 3% as a first time home buyer. For FHA, you can go 3.5%. And you do have some veterans out there. So if you go to VA loan, then it's 0% down.
Okay. Sound like my grandfather. My grandfather need to hit you up.
Yes, sir. Yes, sir.
He is in the market of buying a new house. So yeah, I'm gonna tell him to hit you up.
Yeah, we'll talk about that out afterwards, man.
For sure. Go ahead, get you in the door. But so if I'm okay, let me put myself in the customer shoes real quick. If I'm coming to you, and so what should I have, in place before I even speak to a real estate agent or even a mortgage loan officer? What should I have from the jump? Should my credit score be a certain number? Is it a certain qualification? 580 to how does that work when it comes to getting the best rates? Like 580, I know of course the interest rate is going to be a little bit higher, but can you explain that for us?
Yes, sir. So pretty much exactly like you said, man, you can go 580, and there's even ways you can go as low as 500. But those, so you can go 500, but if you go to a 500 credit score, you are going to have to put down like 25% down.
Right.
And it's going to be really expensive for you to get it, but it is possible to do that.
Right.
But I don't really ask anybody to come to me, particularly like any certain type of way. It's really like, hey, come as you are. And like I said in the beginning, we're going to find a way to get you there. But just in general, as far as like best pricing, if you were there are traditional like standards, I guess, if you will. So for 640 is kind of the, I would say, the good area right there. If you had 640, I'm feeling really confident. Like, okay, we possibly could go ahead and get you pre-approved today. With a 640, you have a lot less restrictions on that.
Right.
Whenever you are at 640, because the difference is outside of like interest rates and pricing, you outside of those, it's gonna be guidelines. So the lower your credit score is, the stricter the guidelines are for you, far as like what you're required to have in assets, what your debt to income is gonna be required to be, how long you had to be on your job, things like that get a little more stricter, and the requirements become more for you the lower your credit score.
That makes sense.
Okay. So you did mention debt to income. Can you explain that a little bit more? Go in a little bit more detail about debt to income.
So your debt to income, again, that's going to be, your debt to income is what determines how much you can get pre-approved for. Because like I said, we talked about 57 and 50% debt to income. But for easy math, let's say 50% is your debt to income. So that means, say if you make $3,000 a month, 50% of that is going to be $1,500. So that means your total debt, your total monthly debt, and your new expected mortgage payments can't exceed $1,500 a month.
Okay, got you.
That makes sense.
Yeah. Okay.
That makes sense. So
Made it real simple.
yeah. Yeah, that's real simple. So I guess kind of piggyback on interest rates. So do most lenders charge for interest rate lock when it comes to, I guess, locking in a certain specific interest rate? How does that work?
I can't necessarily speak. I can't say most lenders. Some lenders will, like me, like my company, we're not going to charge you for your interest rate lock. Like if you're locking 30, 45, 60 days out, we're not going to charge you up front. So technically you will be charged at the closing table though, right?
Okay.
So you do have, it does cost you more to lock. The longer you have to lock the loan, the more it costs. But that's going to be, again, you're only going to get charged at if we're able to close on your house. So it's not going to be if you lock a house for 60 days and then you don't close that you still owe me something. At that point, you don't owe me anything because we didn't close on your house. So for me, myself, and my company, New America Funding, we're not charging you. There's no such thing as like a best efforts. I can't charge you because I tried to get you approved for a house, or because I thought I was going to get you approved for the house. If I can't close on that house for you, then you're not going to be charged at anything. I'm not charging you anything for it.
Okay.
That's good stuff. So I kind of want to make a shift. So I was doing some research, and I'm not skilled in this industry, but I was looking up some stuff. And so I guess when it comes to like a business owner or somebody that's a regular working employee, is there a different process when it comes to somebody who's self-employed compared to somebody who has a W-2? Is there a different process in that?
The process itself isn't really different. Now the documentation is going to be a little bit different in some of the requirements, right? So like say if you're W-2 or salary, you come to me, and even if you've been on your job for, say you only been on your job for 7 months, that's cool. We can just look at your pay stubs, your W-2s, and your offer letter from your job, and we can use that to qualify your income. Now, if you're self-employed, you typically have to have been self-employed for at least 2 years, and we're going to use your 2 years tax returns to determine your income, because and that's just what was determined. Okay, 2 years is good enough for someone that's self-employed to determine what their normal monthly average is going to be for income. Because if you're self-employed, you know, 1 month you might make $5,000, another month you might make zero, and so 2 years is a time frame that's needed to determine what your qualification is, because you can't be self-employed and for 1 month and show us that you made $10,000 last month and us expect, okay, well now your monthly income is $10,000 a month.
Right.
It's just unrealistic. Whereas someone that's W-2, you know, typically your hours are going to be 40 hours a week is going to be what you make. I mean, what you do for the most part. If you make $20 an hour, that's standard, and that's going to be expected to continue.
Okay.
Now, when you're speaking about, you know, down payments for homes and everything, On a $300,000 home, 3.5%, is $10,500. Are there any assistance that actually help you get that closing cost or that down payment?
Yes, sir. Yes, sir. They have a couple different down payment assistance programs. Now, I can't really name drop any. I know of some. So if you were come to me personally, I can tell you what's best for you. But there's not really a one that's blanketed across the board. They always help. Because even those, they're going to be based on your particular situation. You have to be at a certain debt to income. Your credit score has to be at a certain amount. Even your even how long you've been on your job, all those things are going to come into play. So you have, there's hundreds of different down payment assistance programs and grants and things that you can get. So it's just going to depend on you.
Okay.
All right. That's good stuff. So I guess even going through that process. So let's say for me, if I was in those shoes of getting a house, so me and my wife, we went through the process. We've got our credit, all that stuff done, and documentation, all those different things. Would there be, I guess, extra fees charged, at closing when it comes to the closing process at the end?
Yes, sir. There are more fees closed outside of just your down payment assistance. And that's another thing I do want to bring up about down payment assistance, because a lot of people do think okay, I can get down payment assistance so I can get a house for free, or I don't have to pay anything at closing. That's one of the biggest myths there, because down payment assistance is just that. It just assists you or covers your down payment. So there are closing costs like your prepaid taxes, your insurance, title fees, and things like that are also due at closing that down payment assistance would not help you with.
Okay.
So you do have to prepare for those additional charges at closing like that.
Okay. That's good stuff. That's something I want to know, because I've heard a lot from most people when it comes to, I guess, looking for a house or buying a home. Man, we ain't got to put nothing down. Nah, that's not what I said. Yeah, I don't think there's a such thing as getting a free house.
Nah, man, I hear it all the time. Trust me, I hear it all the time. Somebody come, how much were you expecting to pay at closing? It's I was trying to get in with paying nothing. Wait, so let me get this. You want to buy a house and you want to get in it with nothing out of your pocket? Yeah, man.
A fairy tale world for real.
Yeah, I'm sorry, I don't know what Google article you read, but that's not really happening today.
Now, see what it is. People be watching HGTV and all that stuff, and they don't tell you the full story. So that's what people get their information from, HGTV, and like you said, Google. Man, I know a lot of people who have mistake a lot of stuff in the mortgage industry just because, I'm an expert because I watch HGTV property. Come on now. That's just they show you bits and pieces. They don't show you the whole entire story. So
yeah, man, that's like saying you can be a doctor because you watch Grey's Anatomy or something. It's just come to me or come to your local expert that actually does it for a living. Ask your questions that you need. Just like doctors tell you to stay offline trying to diagnose yourself, I always say the same thing. Stay offline trying to pre-approve yourself or find out what your next steps are for the loan process. Just contact your loan officer and kind of go from there and let them handle it and lead you in the right way.
Okay.
I guess to piggyback, so let's say for instance, so I know right now with this process of people buying homes right now with the housing market being, crazy and different stuff like that. So let's say, for instance, if I had a house, it was worth, let's say, $300,000, and with the market being what it is, would you recommend somebody selling or waiting until the market works itself out to be able to sell their home and get the equity that they need? How does that work?
Ooh, man, that's a good one. I can't necessarily recommend because everybody's in different situations, right?
Yeah, right.
Now it is a seller's market right now, so I am seeing a trend of a lot of people are able to sell their house for way more than what it was worth last year or way more than what they bought it a couple years back. So a lot of people have been able to capitalize off the seller's market to where they bought their house a couple years ago for $200,000, and this year they're able to sell it for $350,000. I have seen that, and so those people I've seen some people, like I said, capitalize and make some good money off of what they had in there. So those people are able to live good, take that money, either go buy another house or go renting and start investing that money. So it's up to you. If you need the money and you want to do that, then hey, go for it. The market is there. Now, the flip side of that I will say, and again, I'm not advising anybody what to sell their house or not sell their house, but the flip side of that is that because it is a seller's market, houses are more expensive than what they were before. So even though you're selling your $200,000 house for $300,000 this year, so you're making $100,000, right?
Right.
But in order to buy you a house, you can't buy a house for $200,000 no more either. Now you're gonna have to buy a house that was $300,000 a year ago. Now that house is $400,000. So a lot of times, some people are having to spend everything that they just made from the equity of selling their house right back just for a house is not really worth what they thought it was, or what it wasn't worth a couple years ago.
I know this Texas market is crazy because we got all these businesses relocating, from California, and you got these people in California who may have like a $600,000 house. Down here it's like $300,000. So they're selling their $600,000 home, and then they coming down to Texas, and all of a sudden it's a bidding war. Like you're trying to purchase a house, and say, okay, I'll come in with a $300,000 offer, but you got a guy who sold his house in California, like he got that $600,000, and he done purchased him a home for $250,000 down here, but he still got $350,000 left. So you can't, it's a bidding war, so you only have an X amount of money that you can actually put up. So how is that affecting the market? Like, with these people coming into California, and these investors and everything is outbidding, just normal everyday clients. How is that affecting that?
Man, some would say is the reason why a lot of those prices have been driven up, man. The pandemic, it had a lot of people to where, like, take for instance California, where they're historically a lot more expensive than we are here in Texas, but now they don't have to live in California, but they still get to make that good income from California, but they're working from home, so they moving here and able to do exactly what you said. So it is driving the market up. It's causing a lot of bidding wars and things like that. And so, I mean, it's up to you ultimately, right? Though, because value, you get to decide what you value something at.
Right.
So, I mean, for that, it's like, if you see a house, if this is your dream house, I mean, it might be worth it to you to pay $50,000 over what you think the house is worth, because this is your forever home. This has everything you in it. But again, if it's not your dream house, you thinking that this is about to be something for you to live in for a couple of years and then move out, then you have to think a little bit harder about if you want to pay or get into a bidding war and pay more than what the house is expected to be worth. And then also you have the thing about having to meet appraisal. So what happens is, if you put in say the house is going for $300,000 and you want to win it, so you put in an offer for $350,000, it's accepted. If the house only appraises at $300,000, now you have to pay that $50,000 difference than what the lender is willing to loan you for. Because we can only loan you based off of the value of the house. So the value comes in at $300,000. That's what we have to determine the value at. So now your loan has to be based off of that. So if you want to do it at $350,000, that's cool, but you're gonna have to make up that difference. We're not still gonna loan you for a house. We're not still gonna give you $350,000 for a $300,000 house.
Right.
We're upside down, and it's a big risk, and that's just not worth taking.
Right. So, in the how the market is today, so it makes more sense just to get a new build, right? Or what do you think?
So the thing about new builds, you don't get into as many bidding wars as you will, because a lot of times a new build, to my understanding, you go into the office today of XYZ new build company, right? And then you go in there, if they have available lot or available plan, you go ahead, you make your down payment or whatever the process is, whether it's already built or you about to start the building process of it. But they're just theirs is kind of first come, first serve. You go in, if they got something available for you, you make the offer, they accept it, and that's the end of that. They don't really get into the whole bidding, and if somebody's going to outbid you, they don't do that. It's first come, first serve for most new builds.
I know I've heard too, also when it comes to, I guess, having a home and paying it off. I know I heard putting money, I guess, towards the principal when it comes to, I guess, the interest as well. And so what's the difference, or what's the meaning of a prepaid penalty? What's the meaning of that?
So some lenders out there, if you pay your house off too early, they have what's called a prepayment penalty. So say if they, for the easiest way to put it, if they banked off of making money off of you over 30 years, but then you pay it off in 5 years. They didn't make the money that they thought they was gonna make, and so they'll charge a penalty because like, hey, we were expecting to make $10,000 off of you, but we only made $3,000. So because we didn't make what we wanted to on an investment, pretty much, we have to charge a prepayment penalty. Now, my company, we don't have prepayment penalties. If you have a 30-year term, but you want to pay it off in 2 years, there's no penalty for that. Just pay it off and you're good to go.
Oh wow, that's that's good stuff right there. I guess kind of piggybacking off of that. So I guess when it comes to going through that process of closing on a home and all this different stuff, how long would you say the process takes from the application to closing? How long? What's that time frame look like? Or does it just depend on the person and their assets and stuff like that?
So from the moment you have an accepted offer on a house, that typically can take, I'd say 30 days average. It can take a little bit less, but 30 days I would say is the average that it would take from the moment you have a home and accepted offer to the moment you're able to close on and pick your keys up and go from there.
Okay.
So at the closing part, what costs are actually negotiable? At the closing part.
So typically you would have negotiated beforehand, but a lot of times you're going to have, like with your lender, you might have origination charges. You might have what they call discount points that you have to pay for your certain percentage rate. And so sometimes if you can negotiate those. You also have the option, like your title company, they might have certain fees. You can talk to them sometimes and see if they'll negotiate some of their fees. Like, hey, that's a little high. I saw XYZ company doing this. Could y'all match that for me? So you can negotiate things like that. Now, what's not negotiable, of course, what's not really negotiable, I would say, is like your appraisal fee.
Okay.
That's one. You can't negotiate your appraisal fee. You can't negotiate your taxes. What the taxes are on that property are going to be those taxes, regardless. That's set by the city.
Right.
And then you can negotiate your insurance, if you will, because insurance, you have to pay that at closing.
Okay.
But you choose your insurance company. So if you want to go with company A, company B, company C, you can call all around, find out who's offering you the most inexpensive insurance policy. You can go with them, and that's going to be what you're charged.
Okay.
I know you mentioned mortgage points. I've never heard of that, man. I know there's points you give like credit cards and stuff like that, but mortgage points when it comes to the home, I never heard of that. So
yeah, a lot of people haven't actually, man. So more discount points are gonna be, say if the rate today, if you come in with your credit score, your debt to income for this purchase price, the interest rate is on what we see is 5%. But you tell me, I don't really like 5%. I want to do a little bit more. So we can charge you, say if you want to go down to like a 4.875, there'll be a certain amount of points that you're charged for that. Like, you can get 4.875, but you're going to be charged for it. So you might get charged, I don't know, say call it $1,200 to knock your interest rate from a 5 to a 4.875. That's what they call discount points.
Okay. Never knew that.
Yes, sir.
Good information right there.
Yeah, never heard of that.
And a lot of people don't. So sometimes when people get caught up and they'll kind of go shopping around for the lowest interest rate. And sometimes it is what it is. It's just the lowest interest rate is just the best loan. But the thing that people don't know to look out for is like sometimes you're getting a better interest rate, but you're paying for it. And so it's not really apples to apples. Like say somebody come to me, I'm like, okay, yeah, I can get you a 5% interest rate. They go to another company. Oh yeah, this company's able to give me 4.5. I'm gonna go with them. Then they end up going over there, but I'll find out on their loan estimate, like, yeah, they're giving you a 4.5, but it's not necessarily a better rate than I'm offering because they're charging you additional $10,000 at closing that you didn't know about or that you weren't paying attention to. You were just focused on getting a lower interest rate. It's like, yeah, I can give you a 4.5 if you want to pay $10,000 for it, but do you want to pay the 5% interest rate and be able to save that $10,000, or do you want to save yourself $70 a month and pay $10,000 up front?
Right.
Wow. Okay. That's good stuff. I know you mentioned too earlier FHA loans and also conventional loans. And so what are VA loans and USDA loans? What do you know? What do those consist of?
So VA loan is going to be a veteran's loan if you were in the military. That's pretty much the easiest way to put
Put
VA
it.
VA
Right.
loans. Yeah, if you're in the military, then you probably you could be eligible for a VA loan, which again you can get in with 0% as a down payment. They also have VANAs or VA non-allowables, where there are certain fees that your normal person would have to pay that are associated with a loan that a veteran doesn't have to pay. So they just get an all around really good deal because they did serve the country.
Oh, wow.
And USDA loan is going to be like an agricultural loan, and so that's a zero down as well. But the thing with USDA is that your debt to income is a lot lower, so you have to be like at 45% at most times. And then also it's per property. Not every property is eligible for USDA loan. It has to be in a certain area and zoned a certain way before it'll accept a USDA loan.
Okay, that's a good breakdown.
So getting back to like scores, like your credit scores. So how does that work? I know you get, your TransUnion, your Equifax, and your Experian. Do y'all take an average? Do you take the middle number? How does that process work?
The middle number.
The middle number?
Yes,
okay.
sir.
Okay. So when you take the middle number, say for instance, it's at that 640, and then after that, I mean, what's next after that? What's the next step? Like you saying, hey, I got this 640. I got my pay stubs. I got everything that I need. Like, what is the next step in the process of, continuing, to pursue a house?
So you come to my office. We're looking at three things. We're looking at your credit, your income, and your assets. Those are going to be the three major things that are going to determine your pre-approval and your amount. So I'm going to pull your credit. Cool. I'm on all three of yours. It's 640. My next step is I want to look at your income. You give me your pay stubs again. Your salary, you make $3,000 a month.
Okay.
And so I'm going to use that. Then I'm also going to look at the liabilities from your credit to find out what your monthly obligations are for all your bills. Then I'm also going to look at the purchase price that we're looking at to find out what the expected monthly payments are for your $200,000 house and see where your debt to income is.
Okay.
If say all that looks good, your debt to income's under 50%, your credit's 640, 660, whatever your credit is, everything looks good. The next step is I want to look at your assets.
Okay.
Because if we know what you're already pre-approved from possibly pre-approved for your debt to income, it's $300,000. At that point, now I can come up with expected funds to close.
Okay.
Or cash out of pocket based on like what the down payment is going to be, what the expected taxes are for that place, expected insurance, title fees, things like that. And say it's $20,000. So at this point now I want to see your assets to see where this $20,000 is coming from. Whether it be checking, savings. You can also use like your 401k, stocks. Like some life insurance policies can be used as assets, but I just want to know what are your expectations to cover this $20,000. And once you show me that, at that point it's pretty much okay, cool. Here's your pre-approval. Go find a house. And at that point, we get you, whether you have your own realtor, we get you connected with a realtor, you go out, find a house. And after that point, you bring me an accepted offer. We go through, we order title, we get the appraisal order to make sure that the value meets it, make sure that your $300,000 house that you're buying is worth $300,000. And we'll get updated documents, again, pay stubs throughout the process, because maybe we're 30, 45, 60 days into the time that you originally came into my office. So we want to make sure that you're still making what you were making previously. Make sure you still have access to that $20,000 assets. And then we pretty much go to title. Make sure the title is clear. Make sure you don't owe the government anything or anything crazy like that.
Right.
Make sure title's clear and you close on the home.
Okay.
Good information, good stuff. So I guess kind of piggyback what he was saying, all the information, the things that you would need when they come to you as far as getting a home. I guess what are the determining factors when it comes to, I guess, the length of the loan or the length of the terms? I know you have different time lengths. Was it 30-year, 15-year, 35-year? What's the determining factor?
You name it, you can do the loan. You can do a 26, a 17, a 13-year term. It's going to be ultimately up to you and your debt to income, because of course, the lower the loan, or the lower the loan term, the more expensive it is.
Makes sense.
Just basic math for that, right? And so as long as your debt to income still covers it, it still has to be nothing changes. So it still has to be either under 57 or 50% debt to income, depending on which loan program you're going. But as long as you're still qualified for it, then other than that, the process is still going to be the same.
Okay, that's good stuff. Well, man, seem like we didn't drilled in them.
Hey man, it's all right.
Hey, man, it's all good information, man.
Yeah,
It's all good
yeah,
information,
very,
man, for
very
real.
valuable information.
I can talk
man.
about this all day, man. I'm kind of a nerd with this stuff, if you will. So man, I can sit here and talk to y'all for 3-4 hours on, man, about this going on. So I don't mind.
That's good though. That's good though, bro.
Yeah,
The
real
fact that
talk.
you know your stuff, you know your craft, man. You put the time and the work in order to learn these things, in order to bring value to people that's in that process of trying to get home. So we definitely appreciate your wisdom and your knowledge and stuff that you're able to bring to us. So yeah, man. I guess we can put a wrap on it, man. How can people get a hold of you, man?
Man, you can call me. I got my office numbers 469-297-2824. Cell number 682-597-4241. Email is chris.winston@nafinc.com. You can catch me on Facebook, Chris Winston Home Loans. Instagram, y'all_mortgage man. Whichever way you want me, just reach out to me. I'll be able to answer y'all. I'll get right back to you.
We'll make sure to have all that information in the description. So if you need it, hit them up. It'll be in the description.
Yes, sir. Yes, sir. Well, Chris, man, we appreciate you getting on with us and sharing that information, man, bringing value.
So before we let you go, we always want to ask our guests, what are their mirror moment? What is their
yes,
mirror
sir.
moment?
Yes, sir. Yes, sir.
Mirror moment could be when you look in the mirror and say, hey, this got to change, man. I want better for my life. Can you share with the listeners a little bit about your mirror moment?
Ooh, man, is it just one?
It could be how many
Man, however
How
many
many?
on your heart, bro.
Man, I got about 30 minutes, man. I have one about every year, man.
Man.
No, man, I think my first one might have been, man, after high school. I was working at a warehouse. I thought it was a good job at this time. Fresh out of high school, I wasn't making any money, so I was going to this warehouse, making like $10 an hour. I thought I was rich, man. I was working there, giving them all my time, man. And then I ended up getting fired, and that kind of threw me for a loop. And I was down bad. I had just me and my wife, we had just got married.
Right.
Oh no, we were getting married like a couple weeks after I had got fired. And I was like, man, what the heck? How am I supposed to go into a marriage and I don't got no job? And it really had me in a bad place because as a man, if you can't provide, at that point I didn't know what I was supposed to bring to a relationship. So it kind of had me. So it really made me kind of sit back and kind of figure out like what I was doing. But I needed that moment, honestly, man, because before then I was gonna kind of just coast through life. I probably would, if they would allow me to, I would have stayed making that $11 an hour at the warehouse for 30 years if they would have let me to. So it kind of forced me to look at myself and try to figure out what I wanted, what I needed,
That's good.
and what was best for me. So I would say that was the major turning point in my life, because before then I really hadn't thought I haven't thought much about doing anything else besides just working, collecting the check, making sure I'm able to pay my rent, able to eat.
Right.
And that was going to be life for me at that point. But once they fired me, I had to kind of sit down, kind of figure out what I wanted to do. At that point, so the next year, I was unemployed for like a year or two. Then after that, I had about 4 or 5 jobs within the same year, a bunch of terrible jobs. I don't know what I was doing.
Yeah.
And so but yeah, man, but my wife, it was really her, man. She kind of sat me down one day. She knew I was having a moment, and she let me know that we were here together to find out what my next move is, and that I wanted a job, and she wanted me to have a job because she know I needed that for myself. But she let me know that I had more to bring to the table, and that was kind of my moment. I was like, dang. She sees it in me, but I don't even see
myself.
I don't know what else I had to bring to the table. Like, unfortunately, but as men, that's what we're taught, man. You go to work, you make money, you pay bills, you make sure there's food on the table, and that's really what a lot of us are taught, unfortunately. So that's kind of what. So when she told me I had more to bring to the table, I was shook, man. I was like, what's she talking about? I don't got more to bring to the table. I have to go to work. I'll make you happy, and we good. Right. And so we had a couple of hearts after that, because it took me a while to even accept that, man. But it sent me on a journey to find out what I wanted to do. And I always knew that I liked helping people, but I didn't know which avenue, because helping people comes in many different forms, right?
That's true.
So it took me a while to kind of figure that out. So that's why I got into real estate. Okay, cool. Let me help people get a house, and especially you know about the historical differences between the brown community and how home ownership is so low. And so I was like, okay, I like that. I like houses, and I always like talking to people. All my teachers told me I talk too much in school, but I couldn't figure out how to mix everything that I liked and what I wanted to do. So I got into real estate, did that for a while. I had fun turning people into homeowners, or even helping them get just rental housing, get out the apartment, trying to show them what more there is out there. And then after that, like I said, I got tired of not being able to help people because they weren't able to get approved for loans. So now I'm over here in the home loan side, looking forward to help more people get into house, educate them, and just really make sure they're making informed decisions, because a home purchase is going to be the biggest the biggest purchase that most people make, man. I really take pride in being able to just help people turn their life around, man, because like so many people cry whenever you get them approved because they just didn't know it was possible. Yeah. Right. Which also brings me to another mirror moment of mine, because whenever I bought my first house, I didn't even know I was buying the first house. It snuck up on me. Me and my wife, we was just driving around in Dallas. I think we was out there to eat, and we had a restaurant reservation. Right. We was early, but we was already in Dallas. I'm about to go all the way back to Fort Worth just for another hour. So we're driving around. We came across a little sign that said "Get pre-approved today." And so we were going in there, and our original thought was, let's go in here. I know our credit's bad. I know we don't make that much money, but let's go find out how far away we are from being able to buy a house. And we both thinking like, okay, we're probably about a year or two away from buying a house. And so we go in, we do the process, and they're like, okay, you're pre-approved. And we both look at each other like, what the heck? Like, what do you mean pre-approved? Like, what? Like, pre-approved for what? Like, we pre-approved to buy a house in a year? He's like, no, you can buy a house today. Right. And then we had to go outside and like, did you hear what I just heard? Like, yeah, like, so what's he mean we're pre-approved? So we talking to each other. We both shook like, nah, I think he mistaken or something. We can't pre-approve for the house. Went back in there. He gave us a pre-approval, set us down. He talked to the underwriter, and then the rest is history, man. We ended up buying a house, and that moment, I remember how I felt, and it just felt good. And I just wanted to be able to give somebody else that feeling. Because like, I don't know, man, it's nothing better than being able to put a smile on somebody else's face, especially when they needed it, man. Yes, sir.
Yeah, that's powerful, man. Definitely powerful testimony, how you make that transition and sharing your mirror moment. So I kind of want to, I guess, from biblical standpoint, you know, us being believers and black men and followers of Christ, 1 Corinthians 13:12 says, now we see things imperfectly, like puzzling reflections in a mirror, but then we will see everything with perfect clarity. All that I know now is partial and incomplete, but then I will know everything completely, just as God knows me completely. So just kind of put everything and tie everything together, man. At the end of the day, when we looking in the mirror, like my brother Ishmael always says, man, if you're the one always pointing fingers at other people, that means that your mirror is dirty. That means that you're not really looking at yourself and fixing the problems and the issue that you need to fix on the inside. And so the moment you do clean that mirror, shine it up and get it right, then when God will reveal to you, okay, these are some things that you need to work on in order for you to grow, thrive, and be better in whatever area that he's called you in. And so, man, I'm definitely blessed for being able to hear your testimony and your story, man. Very, very powerful. Very powerful.
You have to send me that scripture there, man.
It's funny. I shared this with Ishmael, man. I
like that. That's perfect, bro. Man.
Yeah, it came to
me. That's good, man. I appreciate y'all fellas for having me on here, man. I appreciate what y'all doing, man. Giving a voice to people, man. Letting people hear about it. I think just a mirror check itself, man. That name itself is powerful, man. You don't even have to say nothing else. Just mirror check makes you think. You really got to ponder on it. Like once Woody told me the name of the podcast, I was like, dang. We didn't even have a conversation about it. But it was just like I already knew, just knowing who he is and who you are, Ishmael, and then the name itself, I was like, that's deep. I really want to find out more about it, but like I said, just from the surface, I already knew kind of where y'all were going with it, man. So again, I appreciate you brothers a lot, man, for having me here, having this conversation with me, man. Anytime y'all want me back, feel free. Next time we can just talk about something fun, man.
we will bring you back, my brother.
And clown and do something like that, man. But I appreciate y'all.
Oh yeah, for sure. Yes, sir. So yeah, we will have you back though.
Yes, sir.
And maybe next time we may even live stream it so we can kind of interact with the people out there. You know,
I'm saying
they
some
may
questions.
have questions, you know,
Yeah.
that we didn't cover, you know, and I'm pretty sure you can answer it. So they'll be later on in the future, but we'll stay in contact with you.
Yes, sir. I appreciate y'all, man. Love y'all boys.
Appreciate
Love
you.
man. Love you too, man.
Yes, sir. Appreciate you.
What's good, my Mirror Check family? It's your boy Ishmael. I do want to thank y'all for tuning into another episode of Mirror Check Podcast. If you've been listening, we're on a series entitled Breaking Generational Cycles, where episode 1 was about credit repair, episode 2 was about mortgages, and this third episode will be about life insurance. You know, it's crazy that we live in a world that we can't go for a jog or walk through our communities. We can't even shop at our local grocery stores. We can't even attend a place of worship. Can't even sleep in the comforts of our own bed. It's just crazy the type of world that we're living in. So it's very important that we have life insurance in place so we'll be able to leave an inheritance for our family. With that being said, this next episode, we will have a special guest who goes by the name of Rigel, who will be able to give you the ins and outs of life insurances, the different policies that's out there. You know, like I said, the world that we live in, it's crazy that we can't, you know, just enjoy life without worrying. You know, we can't enjoy life or educate ourselves or send our kids to school without worrying. We can't go for a jog without worrying. If we're going to come back home, it's just sad, the world that we live in. So we just want to make sure that we educate our people to have life insurance in place so we'll be able to pass down something to future generations to make sure they're ahead of the game, because that's very important in today's world. So I can't wait for y'all to tune into this next episode. In the meantime, y'all be safe, stay prayed up, and always check your mirror. What's good? It's your boy Ishmael. I want to thank you for tuning in to another episode of Mirror Check Podcast. We will be launching new content on Apple Podcasts, YouTube, Spotify, Deezer, Transistor, any platform that you can listen to on podcasts. Best believe we are on it. We'll be launching new content every Wednesday at 12 p.m. noon Central Standard Time. In the meantime, do me a favor and follow us on Instagram at Mirror Check Podcast, on Twitter, Mirror Check _, and go please like and subscribe to our YouTube channel, Mirror Check Podcast. Also, go to our website, www.checkyourmirror.com, to support and purchase new products. Remember, if it's always someone else's fault, your mirror is dirty. Until next time, peace.